So I welcome questions. Anything that you guys have, anything I can answer, I'm more than happy to answer, to kind of step in. I'll start off with obviously what we're here for tonight, improving your credit score, either rebuilding or building your credit score, and then once you've got it established, or if you have some things, how we can improve it. I'll start off with kind of a story, and I know these are being recorded. Hopefully my wife doesn't see this. She might be a little upset, but long time ago, brand new dad, newly married. We have our first little baby. We decide it's time to buy a home. So we go. I'm a little new. I started off as not even a part-time teller. I was an on-call teller. So I just sat around at home until 10 a.m. And if the bank needed me, they called me. If they didn't, then I could do it whatever I wanted for the rest of the day. So just a little on-call teller. So we decide it's time to buy a home, our first little home. And so we go in, we apply for a mortgage, and they come back and they say, well, this is the interest rate you're going to get for your mortgage if you and your wife are joint, which was obviously what we wanted to do. And they said, but if what we didn't know is that when we had our little baby, everything was in my wife's name with the hospital. Well, there's so many different hospital bills you get and this and that. We ended up finding out there was a bill we didn't pay that was under my wife's name, and it went to collections. So they said, this is your interest rate if you both are co-borrowers. This is your interest rate if it's just you, which was a lot lower because of her credit score. So obviously, she's off the mortgage. Sorry, but it's not, I want that low interest rate. And so we end up getting that resolved, taking care of that little collection on hers. But that is kind of where we're at with our credit scores. It's such a factor. Well, now it's affording a home now is a lot different than when I was trying to afford a home. But so that's kind of our story. Is she wasn't allowed to be on the mortgage or on our first home. I was able to eventually get her on the title, but she just couldn't be on the mortgage. But now that we're here in Cedar, we've cleared it up. She's on our mortgage now. She's on our home now. But that very first time, that was kind of our introduction to getting a mortgage and how credit affects your rate and your terms. So we'll talk about that as well. Is anybody here familiar with Dave Ramsey? I'm familiar with Dave Ramsey. I'm a big Dave Ramsey fan, and his biggest thing is you cut up your credit cards. So obviously being the director of credit cards, of card services for State Bank of Southern Utah, I know that's probably not what I should be saying, but I am. I'm a big Dave Ramsey fan. I've been through Financial Peace University, and I also understand that credit is a tool that we've got to have and that is necessary. And so we want to be able to understand it and then to use it, how to use it wisely, and then how to maintain it as well. So I wanted to go over some credit score essentials, and then that will lead us up to how we maintain and how we improve our credit scores. So the first one I want to talk about is we want to go over is how does your credit score affect you? How do you use it? How credit scores are calculated. And there's going to be different ways that different credit bureaus calculate a credit score. We'll talk about what's considered a good credit score. And then the last two are kind of interrelated. How you get started and then how you improve your credit scores. And so we'll first talk about what a credit score is used for. Credit scores are used for getting approved for a loan. Is what the banks use to consider the risk of a customer when they're lending out the bank's money. Credit scores are going to be used to affect the rate or the term of your loan. Whether it's a mortgage or an auto loan, that's what we can use to consider different terms or different rates that go with that. Your credit score can also be used for jobs or rental or insurers. They can check your credit score as well. Kind of with that Dave Ramsey kind of mindset, I enjoy this quote from Susie Orman. A person's credit score is either a great tool or an awful burden. And in most cases, you have total control over which it is for you. So let's dive into a credit score then. When we talk about credit score, what we're talking about is your FICO score. FICO stands for Fair Isaac Company. It's all three credit bureaus get together, and they have all their own different ways of calculating credit scores. But that's what they're talking about, is that FICO credit score. The three credit bureaus are Experian, Equifax, and TransUnion. All three of them are going to have a different way of calculating a credit score, and then it's up to the lender to be able to go off of what credit score they're going to use. We'll talk a little bit about what they do. So Experian, there are a lot of things that make them different from one another, but these are just kind of some high-level basics. So Experian includes rental payments if the landlord reports those. Experian will include rental payments if they're on time or if you're late. Equifax uses a different scoring range, and we'll talk about that here in a little bit as well. And TransUnion usually focuses on, they put different weight on different factors. So payment history, length of credit, those things we'll kind of talk about as well. And then we also have what's called a Vantage score. It's not widely used, but what it is Equifax, Experian, and TransUnion, they kind of came together and they created their alternative to a FICO score, and it's called Vantage score. So it's newer. It's just an alternative to a FICO score, but it's not really widely used. A FICO score is still mostly used by lenders. And so, but it is an option, and it's something we'll talk about as well. Let's go on to how a FICO score is calculated. So the heaviest calculation that goes into a credit report, and again, each credit bureau is going to use their own scoring on how they do this, but the average is they always put the most weight on your payment history. About 35% of your credit score is made up of your payment history. So making those on-time payments is critical to maintaining the health of your credit score. The next one is your credit utilization. So what that means is how much of your credit are you using at any given time. So as a basic example, if you've got a $1,000 credit card, are you maxing out that credit card every month to $1,000? Are you using half of that? Most credit bureaus are going to want to see 30% or less is considered good, especially on a credit card. It's usually around, if you're using 10% of your limit, then that's better for them.
So when you say 30, are you talking about like when they close your statement, what that ending balance is, or what you're floating through there?
Great question. It's going to be when they report. So credit bureaus kind of decide on when the lenders report is usually around the beginning of the month, but it's going to be based on whoever you're with. If they report, if your statement cycle ends the middle of the month, then they're probably going to be reporting either middle of the month or close after that. They're reporting what your statement balance was. And again, this is on a revolving line. So this would be like on a credit card. Or if your payments due the end of the month, then it's probably going to be either the end of the month or the beginning of the next month that they're going to be reporting to the credit bureau as far as what your balances were and what your payment history was for the prior month. And so if you have a $1,000 credit card, your payment's due on the 15th of the month, the 14th, pay that thing down. So that way, the following week when they do report to the credit bureaus, it's going to show that your balance was less than that 30 or 10% on that credit card. And then that's going to be a big part of that credit utilization that they put towards that. Does that answer your question?
Kind of, yes. It's just, yeah, that's the part that I just little, it's like, so I I always maintain I'm gonna say a zero balance,
Mm-hmm.
meaning that by the time it says that, like, I have a payment, it's
It's zero.
always paid in
Yeah.
full.
Uh-huh.
I never carry anything, I always paid it in full, but
Yep.
sometimes I might go a couple of weeks without making a payment on it, and I just wait, and then when it's getting ready for the statement to close, that's kind of what I do, is I'll pay off, so that when it closes, I wanna have it show the least amount as I can, saying that it's due by that next payment. Not-
So that brings up a good point. When we're talking about credit cards right now, I'm assuming,
Yeah.
right? So that brings up a great point. So when you're making a payment on your credit card, you're making a payment on the previous month's activity. So if you pay off your credit card, let's say November 15th, you're paying off October's activity. So if you used your card in November, that's not going to be due until December's
Right, but
statement.
I'm paying it off before it even statement closes.
Yeah.
So come on the, say it's like on the 10th of November.
Mm-hmm.
So like, and I already owe nothing come the new, because I've already paid it.
Because you've already paid off the
Already paid
previous
it,
months. Yep.
But I have a balance maybe, so say I have a balance of, say, $2,000 on there, and I'm paying
Mm-hmm.
it so that when it closes and tells me what's gonna be due come December.
Yep.
I'm trying to get that number to show that I owe as least as possible.
Yeah.
Is that what I'm wanting to do?
Yeah, you're wanting to show that's as low as possible, at least below the 30%,
Right, okay.
to show that credit utilization is low. Because what it is the credit bureaus are seeing, are you having to max out your credit card every month? And if you're maxing it out and then it's staying maxed out, then that to them is showing that, there could be financial hardship or some type of a financial burden. Whereas if you're maxing it out, but then you're paying it off before it's ever comes due, that's not being reported to the credit bureau. They're just seeing that you started with a $500 balance and you ended with a $200 balance. That's what they're wanting to see, is that you're able to pay that down. But great question, though. The next one is length of credit history. So if you have that credit card that you opened up when you turned 18, it's got that $500 balance on it. I still have my very first credit card that I opened with Zions Bank when I started, and it sits in my sock drawer, and I haven't seen it or touched it in probably the 20 years since I've gotten it. And what's that?
They don't close you out for not using it?
Well, it depends on the bank that will, but Zions has still got my credit line open. My $500 credit card's still open with them, but it just sits on. And obviously, there's some risks to that. If it's ever used or if there's ever fraud on it, then that's something that I've got to keep an eye on and make sure I'm watching. But
So isn't it bad to have credit cards just sitting there?
well, it's going to depend on a couple different factors. Length of time, because they're wanting to see how long you've had credit established. Now, if I were to only have a $500 credit card and it just sat there for 20 years and I never took out any other credit, then yeah, it's not going to help me. It's only if I kind of use that to establish credit, and then I've always just kept it because I knew that length of time was a factor in how they establish a credit score. And so I've always just kept it, and it sits in my sock drawer, and I haven't touched it or seen it in how many years. But I know it's still open because I've checked my credit score, and I've seen that I still have a Zions Bank credit card sitting there.
There's two other pluses with why you may not want to close that or do anything. Every month, Zions would be reported that one's paid on time, even though he doesn't owe it. So it's increasing his credit score every time. But if you let's say you have five $1,000 credit cards, so you have a total of 5,000 available, and you've got 1,000 charged out, then you got 20% of your balance. If you close one, all of a sudden you go from 5,000 to 4,000, and you've gone from 20% up to 25%, even though you're not spending anything different. So if it doesn't cost it's giving you greater history length and entering something into your credit file every month.
Great point. The next one here is a mix of credit types. So that kind of goes into your question as far as having a credit card or an auto loan or a mortgage. Those things are going to factor into those 3 different credit bureaus to show the mix of credit type you have. If you only have credit cards, those are considered a higher risk than if you have a fixed auto loan payment or a fixed mortgage.
How far back do they go? So if you had a car loan that's been paid off, how far back do they trace that?
That's been paid off for, I'll have to look into that. It could be on there for a number of years as far as if it's been paid off. Now there are certain things like if it was charged off, those can only stay on your credit for so long, or if it was, we'll talk about that. That's coming up here. We'll talk about that as well. And then the last one is new credit. If we go back to that $500 Zions Bank card, if I never got any new credit on that, that is going to affect and go into that consideration with those credit bureaus. If I'm not taking out new credit, but I'm stagnant and just staying where I'm at.
Would that new credit include having credit, say, on something that you already have, having that credit increased?
Yeah, that would.
Versus getting an entirely new.
Yes, great question. It would, yeah. So increases to lines of credit would take that into consideration as well.
So is that new credit, is that good or bad?
It's hard to say that it's good or bad. It's depending on how maxed out your credit is. If you've got, they look at what's called debt to income. So they're going to look at if your income hasn't changed, but yet the debt you're taking on is increasing, then that's not necessarily good. But if your income is increasing and then you're able to take on a little more like new lines of credit, that's going to be good because they're going to be able to show that you're able to service those debts. So it's hard to say good or bad. If your income isn't changing, but yet you're taking on more debt, then that's kind of where they start throwing up red flags, and that's probably when you're going to see your credit.
But getting more credit doesn't necessarily mean you're getting more debt, right? I mean, getting a higher credit limit. So, like to his point that he was saying, if you have you say you had one card with a $5,000 limit, and you've had it long enough, you've been paying on it or whatever, and you're able to get that limit increased, say, from $5,000 to $7,500. So now when you're carrying that $1,000, debt that you've been carrying all along, now it's a smaller percentage of the 75.
That brings up a great point, and that's why with the credit bureaus, it's kind of a shroud. It's something that your potential to take out more debt has increased,
Right.
and so that's what they'll consider as well.
Which should be good, right? The
Which-
potential to take out more debt?
Well, it depends on if your income has changed. If your income hasn't changed, but yet your potential to take out more debt has changed,
Bigger risk.
then they're going to look at that as there's a bigger liability or a bigger risk to the lender. And so it is so nuanced. I wish there was a, X, Y, Z of how this is done, but how they calculate this and how is a lot smarter people have put this together than me. So.
So if you have a whole lot of new credit, you haven't proven yourself with that, and so if I open up 6 credit cards, who else can say, what's going on, and it can't be handled? So that's probably gonna lower my score.
But say if he had 5 credit cards for over 7 years, him taking on that 6th credit card, they're going to come and say, well, we can show over 7 years of history that he's always paid on time. So that's probably going to bump his credit score.
But if you
So-
don't use it, it'll also bump it?
If you don't use it, it's going to establish that length of time, which would be a strength to your credit. Yeah. So I wish there's lots of to go into this, but
That kind of brings up an interesting thing that I heard the other day when I was going through my
Yes, and that is dependent on the lender. So for State Bank, for example, we do have a policy in place that if a line of credit, a revolving line of credit, I should say, isn't used within 2 years, we as a bank have a policy that we close that line of credit. Whereas my Zions Bank I've had for over 20 years, and it costs them money to reissue me a new credit card every 4 or 5 years when my other one expires. And so, but they've kept that, and it still reports on my credit report. So there are different banks, different financial institutions that are going to have different rules as far as if your credit's used or isn't used. Do they close it because there's a liability or a risk factor, or do they keep it and then have to take on costs as far as issuing new credit cards or maintaining that record in their system? So
So their thought was that it's a good idea to pay off your regular things like your phone bill and that with the credit card and then pay off the credit card.
that's a positive because it shows you're using credit and then you're paying credit. You're paying it off. So that would be a positive. And then the length of time that you're able to maintain that is going to be building your credit. That's probably the best, surest way you're building your credit.
Is by paying your bills with the credit card and then paying the credit card off?
Is showing that you're using it and then paying it off and using it and paying it off. It just shows that you're able to use it and maintain it. And so that's
Provided you're staying under
that
30%.
30 or 10%. Yeah, yep. So we're going to get into that as well. So we are going to go back to your question right now as far as different things that influence in the negative your credit. So hard inquiries, and what I mean by that is when you go and apply for a loan, the bank or the lender is going to do what's called a hard inquiry. They're going to pull your credit. They're going to get your credit score from the 3 different bureaus, and that's going to be reported on your credit. So for example, if you go to State Bank of Southern Utah and you apply for a mortgage, we're going to pull your credit to see if you qualify, and that's going to stay on your credit. It can stay up there for up to 2 years. It can stay on your credit report. Say if you go to Zions Bank and you apply for a mortgage there, that's not going to, it's going to be considered a hard inquiry, but the government has come in and said that we want to be able to allow people to shop around. They want to shop rates. So if you go to State Bank of Southern Utah and then you go to Zions Bank and then you go to Mountain America, you can go and apply for different loans, different mortgages to be able to get the best rate that's for you. And they will be hard inquiries, but they're not going to negatively affect your credit. Now, if you were doing that once a month, going to different, then that probably wouldn't be the best. But what they say is if you're doing it in anywhere in a 14 to 45 day is what they say. If you're going around shopping rates, then the government has said that that's not going to negatively impact your credit because they want to give you guys the option to be able to shop rates and find the best rate and the best lender for you. So
Do we know why it is? I mean, that's just by simply checking to make sure I pay my bills, that's gonna negatively affect, it's like, that has nothing to do with me paying my bills or whether, but yet, just the fact that I have to check to see if I do that makes it a negative impact.
yeah, what it is they're looking for is if you're taking out a home equity line at one place and then going across the street and taking out an auto loan at a different place, and then going across the street and taking out a credit card at a different place. So what they're doing is those hard inquiries are showing them, well, he applied at 3 different financial institutions for a mortgage, but yet that's not going to affect your credit. But say if you go to a financial institution for a mortgage and then somewhere else for an auto loan and then somewhere else, those hard inquiries are going to kind of gang up and
Spending money all over town.
And it looks like you're going around trying to get money anywhere you can. And so those types of hard inquiries are what's going to stay on your credit and could negatively impact your credit if you do too much.
When you look at your credit score, that's not a hard one.
No, and we'll talk about soft inquiries. So there's hard inquiries and then soft inquiries. And we'll get into that as well. The next one we talked about are charge-offs. Charge-offs are when you max out your credit card or an auto loan or a mortgage, and you're not able to pay it back for a certain amount of time. The bank will consider that a loss, or the financial institution, I should say, will consider that a loss, and they'll charge the loan off. That can be on your credit up to 7 years. And basically what it's doing is the bank is reporting to the credit bureaus that they took a financial loss. And so that's kind of their recourse, is that they can then say, this individual we had a loan with wasn't able to pay this back, and so we're charging it off, and that's kind of their recourse, is being able to then put that on their credit report to let other financial institutions know that there was a charge-off. Yeah.
That's not bankruptcy, that's just.
Bankruptcy is our next one. So bankruptcy is different. Bankruptcy is when you go to the courts and you say, I am not able to pay this, my mortgage or these debts that I have, and you make an agreement with the courts to either pay back a certain amount or none at all. And those bankruptcies can report on your credit report. Same thing, anywhere from 7 to 10 years on a bankruptcy, depending on the type of bankruptcy you do. Those can also report on your credit report because the bank has taken a loss, but it's not the same as a charge-off. A charge-off is basically, I just walked away, I'm not paying this, I'm walking away. Whereas a bankruptcy is more of a formal, hey, I'm willing to make an arrangement, like some type of a payment arrangement, but I can't pay this back. And so it's reported different. Better as far as for you, yes. Because now better for your credit report is a different story. It's still reporting that there was a loss, even though it's a bankruptcy, there was a loss. But for you as the consumer, you have more protection under bankruptcy as far as what you're able to keep and what you have to give away. If it's a home, you keep your home. If there's other things that, like say you might have to pay back like a certain amount of the debt if you have liquid assets. And I'm not a bankruptcy attorney. That is definitely over my pay grade, but that you as a consumer have certain protections going through a bankruptcy than you would if
If I'm trying to pay off and it's been taking me a long time, but I keep paying, that's not either one, or it is?
Yeah, great point. So if you have a repayment plan, that's going to be different than either a charge-off or a bankruptcy. So say you've made payment arrangements. Let's just say for simple math that you have a payment of $100 a month, but you can only afford $50 a month. That's a repayment plan that basically you're making directly with the financial institution to let them know, I want to pay this off. I can't pay the full amount, but I can pay, this is how much I can pay, and they'll be able to make those arrangements. That might still ding your credit, but it's going to be a lot different than a charge-off to just say, hey, I'm just walking away from this, and that's going to be they're going to report that differently to the credit bureaus than they would a charge-off or a bankruptcy.
Is it possible to come in and just have someone look at your credit, what you're doing right now, and tell you?
Absolutely. That's what we're here for. Myself, my team, I've got a team that works in the bank card department that we can look at, and we've got financial advisors at the bank. We've got all sorts of people here at State Bank of Southern Utah that are more than happy to sit down and set up some type of a repayment program or a budget, and we'll get into that as well as far as how that affects your credit and what we can do on that. You bet.
loan or a higher interest rate at another bank?
Yes, so refinancing credit. We'll get into that as well. But yeah, that definitely can help as far as if you've got a credit card with a higher interest rate or an auto loan with a higher interest rate, being able to refinance that into a lower interest rate, which is going to lower your monthly payment, is a great tool, a great way to do that. Balance transfer. Say you have a credit card that has a higher interest rate and you want to take the money off that credit card, move it to a different credit card that has a lower interest rate, which is then going to lower your monthly payment by, so much amount, which is going to be able to help you make that payment. A lot of different tools and ways that you can look at restructuring that. And that's something that anybody at State Bank of Southern Utah, any loan officer or anybody in my department can look at and help you kind of with those decisions. You bet.
Would they buy that loan from a different bank, like from Mountain America to State Bank?
So probably what they're going to do is they're going to look at refinancing. So it's not so much that they're buying the debt, but they're going to look at, so let's look at an auto loan, for example. If you have and this is kind of where you can get in a kind of the nuance. When you originally took out that auto loan, let's say your car was worth $10,000, it was a brand new car, but 5 years or 10 years later, you still owe $8,000 on it, but now you have a 10-year-old car. You're wanting to refinance that. Let's say you come to State Bank of Southern Utah, they're going to do a loan based off a 10-year-old car. So their loan to value is what they call, is going to be different than when you originally took out that car. And so those are different things that any of our consumer loan officers can look at with you as far as this is the max we'd be able to lend up to, which, if you owe $3,000 on a car that's worth $8,000, then you're going to be just fine. Where you see a little problem is if you owe, $8,000 on a car that's worth $6,000.
Right.
That's when you kind of get into the weeds of it.
I'll adjust it according to what it's worth.
Now, not then, but now. So that's kind of what we look at and what we work with you on as well. So let's take a look at what's considered a good score. And again, this is based on all three credit bureaus. And so this is just kind of blending all three. And so this isn't a hard, this is what this is. It's just what Experian, Equifax, and TransUnion, what they're blended, what they consider a good score. So we'll look at poor. So for anywhere from 300 is the lowest you can have on a credit score up to 579. That's probably telling the lender that yes, you're going to have some past due payments. You probably have high debt on credit cards that you haven't been able to pay down, or you have some charge-offs on your credit score. So that 300 to upper 500s or low 600s would be considered poor. Fair credit score is going to be your anywhere from the high 500s to the high 600s. That's considered riskier, I should say. But you'll still probably be able to get approved, but most likely with unfavorable terms. So a shorter term or a higher interest rate, because the financial institution is going to look at that and say, okay, they haven't had a lot of credit. They're still building their credit, or they've had credit, but they've had some late payments on their credit. So to a bank, they're going to look at that and say, well, okay, that might be a little riskier. So to compensate for that, they'll charge a little bit of a higher interest rate, or maybe the length of the loan won't be for as long, like on an auto loan or anything like that. So that would be considered a kind of a fair credit score. A good credit score is going to be around 670 to mid 700s. This is definitely acceptable. It's a low risk, a great chance of being approved. But again, your terms are probably going to be not the best. You might still have a little bit of a higher interest rate because they do that to basically say, okay, that they have a good credit score, but to compensate for any risk, we're gonna charge a little bit of a higher interest rate. So the riskier, the more money they want to make. So that's kind of the easiest way to explain that. And then very good credit score would be anything 740 and up from there is a great credit score. That is what's going to give you the best interest rate. And that's kind of what, again, if we go back to the beginning, when I very first got a mortgage, my credit score was above 740, but because my wife had that collection from the hospital, hers was below. So that they take the average of the two, and that brought us below 740, which then charged a higher mortgage rate. So by taking her off the mortgage, it was able to go above 740, and I was able to get a lower interest rate because the bank considered it less of a risk to them, so they offered a lower interest rate. And then anything above 799, 800 to 850 is considered excellent. It's basically the bank is saying you've been able to make all, you've never had a late payment, you've been able to make all your payments, you've got a good history of credit showing that. It's not just you've had a credit card for a year and you've made payments for 12 months. This is a long-established credit history with no late payments. That's what's going to get you above an 800 score. And so just to kind of to now go into the how we improve is how do we get started? You can do a secured credit card. If you need to establish credit or if you need help rebuilding credit, a secured credit card is the way to go. What they mean by that is you're securing with either a savings account or a CD your credit card. So if you have a $500 credit card, what you do is you take $500, you put it in a savings account at any financial institution. They'll put a hold on those funds, and that's basically just securing the bank of any loss. So if for any reason if you were to max out that $500, then the bank's covered. They can just go take the money from the savings account, pay off your credit card, and you both go your own separate ways. But by doing that, you can get a credit card, you can make payment, have a payment history established, and then usually after about a year, anywhere 6 months to a year, once you've shown that you've been able to make payments, you've got a good history, they'll then look at that again and they'll unfreeze the savings account and just issue a normal credit card on that. Is how those work. Paying your balance every month or having a cosigner, a qualified cosigner, is how you can also get started. But the main thing is just being patient, making your payments on time, steadily and consistently is how you're going to get started. And so now we're gonna kind of get in the meat of it. And so this is just an hour, right?
I'm sorry, I
Yeah.
got 3 of the 4 items. Could you go back to?
Oh, absolutely.
this for a sec?
Absolutely.
Okay.
You bet.
And so those tiers that you showed, some of them had a fairly wide swing, like, 50 to 70, 80 points.
Mm-hmm.
I would assume that it's not like, oh, you're in this, if you're just in this tier, is there variation from within? So in other words, like in that top tier, is there a difference if you have an 805 versus if you're an 850?
No.
There's no.
Anything over an 800,
It's as good as you're gonna get?
it's the highest credit scores that I've ever seen is about an 830. To get to anything above that is I've never seen it. But then again, I'm not
Right.
any guru or
But
anything.
there's no benefit
No,
to it at that point.
not at that point. Anything over an 800 credit score, you're basically going to get whatever terms the banks offer, and there's not really a benefit. It's more of a if you've got that high of a credit score, you're trying to get that high of a credit score, and so it's more of a. I've had people that. Well, I have people that
My bills.
they go from an 820 and they paid off a credit card and closed it, and they didn't realize they closed it, and they dropped from an 820 to an 805, and they came into the bank just huffing and hollering. I went from an 820 to an 805, and to a lender, to a bank, hey, you're still in a good spot. It's just a personal thing they're trying to do. Yeah, you bet.
Is there a difference between paying off like the total balance on the credit card versus just what's on your monthly statement?
I've heard it both ways, and again, it's going to be up to the individual credit bureau how they weigh that. My philosophy is paying it off to zero every month. Like I said, I'm a big Dave Ramsey proponent. No debt is the goal. Paying that off to zero. If you're just paying the minimum balance, what the bank's doing is then they're charging interest on whatever balance you carry. So even though you're making your payment and you're on time every month, you're still then charged an interest rate on the next month's payment. And I'm just a proponent of paying zero interest rate. That's coming from a credit card guy, and it's what I believe. Yeah, you bet.
But we were told not to pay what the statement says, I mean, not what is due. Like if there's $2,000 due, look at how much you have, purchased after the statement. Like if you've got $2,200 on there, pay off the total amount.
Absolutely, yeah. Pay off the total amount so that then your payment is zero. Yep, absolutely. So paying off that statement balance is making it so that when your payment comes due, you're not charged any interest, and that's my philosophy. That's what I've always believed is that way when you look at your credit card and they say, well, you're being charged an 18% interest rate on a credit card. Well, no, you're not, because you're paying your credit card to zero every month. Your interest rate's zero because you're not charged interest on balances. So that's what I believe. That's how I've always done it. So again, we'll look at, and again, this is just an hour. I don't want to keep you guys or. Oh, well, I don't want to go at that long. My wife is going to be putting our kids to bed, and I'll hear about it. So how do you improve your credit score? Paying your bills on time. That's the biggest that carries the most weight when you are building credit. Sticking to a budget. Again, if we go back to that video at the beginning of it, you're not just buying things, you're not falling into the trap, which, according to statistics, Americans fall into. They have a lot of credit card debt, but being able to, if you have a credit card, being able to be stick to a budget. This is what I use my credit card for, and this is when I pay it off every month, paying it off to a zero balance every month. Paying down debt, especially if you are over that 30 or over that 50% credit utilization, getting that paid down to below 30. Credit monitoring. So this is a big one. There's the government has provided a free annual credit report, and it's called annualcreditreport.com. Every year you can pull your credit report for free. It is a hard inquiry, but it does not impact your credit score. It is your real credit score. And this is a government mandated, it's a law, it's a federal law that you can pull your credit report every year for free. So that way you can monitor that and keep track of that.
Or accurate or things like Credit Karma or things like that you can.
Good question. Credit Karma is going to use, and again, I'm not very familiar with Credit Karma, but they're going to use, an Experian, or they're going to use a TransUnion, or and they do both. Yeah. So they're not using the third, Experian. And so this is going to use all three. Yes.
I think you covered this, but I realized when you said below or under 30, I'm not quite remembering what 30 is.
Oh, we'll go over that. We're going to go over that in a little bit more, because I want to show you the tool that State Bank of Southern Utah offers for free. And so we'll go over that. Credit utilization is what you're talking about. And then with credit monitoring, is dispute any inaccuracies on your credit report. And we'll show you a tool for that as well. So that's the biggest thing is my wife found that she had a collection from the hospital when we had our first baby We were then able to get that credit report, see that there was a collection. We then could have disputed it or paid it off. We ended up just paying it off because we didn't know we had it.
And you got that through this annual credit report?
Well, we got ours when we applied for a mortgage. But had we gone to the annualcreditreport.com, it would have shown that there was a collection item on her credit report.
So finding out your credit score through the bank won't show that?
It would show that as well. If it depends on if it's a hard or a soft. But what I'm going to show you that the bank offers is going to show your credit report, and it's very accurate. It's not a hard pull, but we contracted with a company to be able to do a soft pull for customers to be able to show these are the items on your credit report. Now, it's not 100% accurate because, again, we're not doing a hard pull to show real-time data, but we're doing a pull to be able to show, and I've checked my own, and it was 100% accurate as far as the loans I had out. So
There's also ways to get the collections off of your record so you don't have to pay them as well. You heard of that?
I have, as far as, well, if they were reported in error, you mean?
No, if they're reported accurate, because like say you had something with Allstate, another company will buy that, and then you have to pay that other company. But you didn't sign up for that company to pay it, so you can actually fight it.
Oh, okay.
Yeah.
Yeah. So what you're talking about is like debt reconciliation. So what they do is debt companies will go to a bank or a lender and say you have $1,000 loan that you haven't been paying on. They'll say we'll buy that loan for $100, and the bank has the option to say, well, I'm either out $1,000 or I'm out $900. So they'll sell it to them, and then the debt collectors will then try to collect on that $1,000. But you're right, you can dispute that then because you then didn't sign up for them. And there's a lot of different, but I'm not too versed or familiar with
There's
that.
another
But
company where they'll go after the people that have your collections, but you have to pay them so much. But if you owe like $1,500 or something, what's a couple $100 to
sure.
make that go away?
The next one here is keeping old accounts. Again, that's just kind of having that length of credit history. Limit new credit if you're maxed out. Grouping those hard inquiries. If you're applying for a mortgage, being able to group those mortgage inquiries kind of within that 14-day span. And then Savvy Money, which we're going to talk about. This is the option. This is a product that State Bank of Southern Utah offers to be able to monitor your credit. But the most of it is just being patient, being able just to establish that credit, and then making those payments. You're going to see your credit will then strengthen and then go up with time. So I am going to show now this Savvy Money tool. We'll see if it's going to, it's going to make me sign in here. So let me get back in here real quick. And this is a test account. I am not Alicia Gonzalez, but this is a test account we've created. So there are going to be some things as far as it's not going to be as accurate because it's not a live person we're dealing with. It's a fake made up credit score with a fake made up credit report. So on your online banking, on your State Bank of Southern Utah online banking, we offer this tool called Savvy Money. It's a free tool to you. The bank has it and the bank pays for it, but we offer it to our customers for free so that they can monitor their credit report. So you have the option here that it's just going to show you a quick snapshot of what this Savvy Money tool is showing that your credit score is roughly at. Again, because it's not a hard pull, it's not going to be exactly. If you were to go and pull out a loan tomorrow, it very well will show a different score than what's here, but this is showing the gist.
The ballpark.
In the ballpark, yep. And then you also have the option to access it here. So with that tool, we'll go over the different options you have. This is showing, again, that kind of credit score range here. So Alicia is showing that she is in the fair range. This Vantage score is what we use. It's offered from TransUnion. So it's just one of the credit bureaus that we're getting this from. So you're not going to see the other two. You're just seeing a third of what is being offered. But just to kind of jump in here, you have your score analysis. So this is showing that this rating is being represented by their credit worthiness based on their credit score. So if you click on that, that's going to show kind of how they're calculating the score. And then you can kind of go through these tabs here. So Alicia, her payment history is grade A. She's always made her payments on time. But what you see here is that she hasn't done is she has one account that's in collections. She's got 12 open accounts, but of the 12, one of them is in collections. So that's what's really bringing her credit score down, is that collection account. It's been 10 years and 3 months since you've had a delinquency. This will go over your personalized credit report of what we're able to see with this. You can look at credit usage here. So this will show for Alicia, she has a Discover credit card that is maxed out. And that's that credit utilization that we were talking about. And this will break it out for you as well. So it has if you're over 50% or under 30% is green. That's where you want to be, is under that 30% utilization. If you're between 30 and 50, that's kind of a little bit of a riskier. Anything over 50 is going to be kind of your danger zone, but then 100% is going to be maxed out credit, which then is going to bring your credit score lower, because to them it's looking as if, okay, they're maxed out, they're not revolving it, and that would ding your credit. It's definitely repairable, I should say. If you bring that, if she were to come in tomorrow, pay that down below that 30%, her credit score would increase on that. And it will show you just kind of a breakdown here. Of the $17,000 available to her, she's using $9,956. So of her average, she's using just over 50% on that. And then you've got your credit usage history here. Will kind of show you she's just below that 60% on our credit usage, or card usage, credit card usage, I should say. This will show your account mix. So again, it shows that she's got good account mix. Real estate, credit cards. She doesn't have any auto loans or student loans, but she does have that collections, which isn't great for her. Credit age is great, showing that she's got, on average, over 20 years of average credit. And then inquiries are great too. She doesn't have any recent inquiry, or hard inquiries, I should say, on her credit report. So again, that's kind of your credit. It will go over each of those, personalized to each one of you. The credit report, though, I say is probably the most useful tool in this, because even though it's not a hard inquiry, even though it's not real-time data, again, I use this for me personally, and it shows every loan I ever opened, and it doesn't show exactly the balance that was on there, but it's pretty darn close as far as my credit utilization and what I had. So this is what it's going to look like here. It's going to show your open credit cards. So here's a Nordstrom card that she has. She currently has a $6,700 balance on it, which is 67% of her credit utilization. Again, you want to have that below 30%, ideally. She's got this Discover card, which is at 100% credit utilization. So what you'd be able to do is say, okay, well, if I were to pay that down, if I were to go in and pay that down below 30% or just pay it off completely, you would then be able to check that here, after they report that, and you'd be able to see how that boosts your credit, how that's going to increase your credit. She does have some other credit cards here, but the main one down here, if we keep scrolling down, here's this collections. And you may not, like my wife and I, you may not even know you have a collections. But this will show that company X, Y, and Z is reporting this. If we look at her here, hers is actually a Sprint, which I don't even know if Sprint is a phone. Yeah, I don't even know if they're a business anymore. I know they used to be big, but I don't even know. I haven't even heard of Sprint in a long time, so I don't even know if they're still. But this is showing that Sprint was the one who reported her to collections. So she has an option now. She can either reach out to resolve that with them, or you can, if you keep scrolling down, you can start a dispute. And by clicking on that, what that's going to do is going to take you right to TransUnion, because again, this is offered from TransUnion, but it doesn't cost money to submit a dispute if you have an actual dispute. Say if you have records showing that you paid off that Sprint phone bill, but yet they're reporting you to collections, you can dispute that through any of the credit bureaus. You can start a dispute. You have to create a profile, and they're going to want to try and sell you because they want to try and make money just like anybody else. They're going to try and sell you on credit monitoring or this or that. But it does not cost money to submit a dispute. So you would then be able to start a dispute and say, no, I have record that I paid that off. Here are the receipts, or here's my bank statement showing I paid that off. And they, by law, have to take that off your credit report. If they can show that it was not paid off, then they can keep it on there. But then if you're able to show, well, no, here's the receipt showing, or here's the confirmation that you sent me showing that it was paid off, then they have to take that off your credit report by law. So that's kind of how you would start a dispute. This is the biggest asset that we offer, is just this credit snapshot. It's not a hard inquiry, it is soft, but it is accurate. I just looked at mine today, and it was pretty darn accurate as far as what, and it doesn't cost you anything, but it's just something that you can then kind of come in and keep track of your credit report.
Just once a year?
No, this you can access anytime. Anytime you get on your online banking, you can go in here, and it will show you right here the last time it was updated. And so say November 14th, this is what the snapshot was. Say I come back in 5 days, it's going to show, November 19th. And it's going to show me what that snapshot as of that day looks like. So is not a hard inquiry. It is a soft inquiry, but it is something we offer. It's something you have to opt into and say, yes, it's okay for you to kind of take that soft snapshot of my credit report, but then you can access that anytime throughout the day, and you can keep real-time track of your credit report. With that is, we do offer a score simulator. So this is kind of, because this is a test account, it's not going to be very accurate because it's not an actual person's credit score we're working with here. But you can come in here and you can take a look at, say, I want to take out an auto loan for $25,000. This is saying it's not going to affect your credit. My guess is that's going to affect your credit. If you go in and take out a $25,000 auto loan, that's gonna have an effect on your credit. So this isn't accurate as far as, because this is a test account, it's not showing accurate, but
So that calculator's to kind of give you an idea if you were to go buy this car.
if you were to take it, how would this affect your credit? Would it go up? Would it go down? So this here we can show if we were to get a new credit card. Say we get a $10,000 credit card. See, it's just not, because it's not a real credit score we're working with, It's not showing, but that's going to show you your simulated score. We could kind of play around with these, but this would show if you were to pay off all your credit card balances, you could turn that on, and then it would show, this one kind of does, but that doesn't seem very accurate either, that it would only go up 12 points. But then it would show you a simulated score of how would that then help my credit by paying off all my credit cards? Or how would it help my credit if I were to help or hurt my credit if I were to take out more credit card debt? You have that as well. Yep.
If you pay off an account and close it, when does that do? Okay, you said
Yeah. It's dependent on how long you had that account open. If the account is open less than 7 years, it could not do anything, or it could negatively affect your credit. If the account was open for more than 7 years, say it was one of your longest established accounts, and you closed it, and that was the one that had all your best payment history on it, and it was your strongest established line of credit, and you closed it, it's very possible that could hurt your credit because you're then closing the account that had the most accurate, best payment history on it, and now it's closed, and it's not going to report anymore.
it would be a good idea to pay them down as low as possible, but maybe do what I heard about and like charge a bill to it and then pay that bill off.
And then pay that bill off, yeah. Yeah,
Plus, by keeping it, it's keeping the amount of credit you have available to you, so therefore you can stay under the 30%.
Exactly.
Because if you had $1,000 limit, now you just closed it, now that's $1,000 less dollars that you technically have available to you.
yep, exactly right. So that's going to help your credit utilization, keeping you below that kind of 30% threshold. Now, on the opposite end, say you had a $1,000 credit card that you were always maxed out on. Say you put in the work and you paid that off and closed it. That most likely is going to help your credit because then you're able to show that you had this loan that was in trouble, but you were able to pay it off and get that. I'm getting messaged on my, he knows I'm still up. That's going to show that you were able to get that loan that was in trouble, paid off, closed, and then it's not part of your debt anymore. So it's very nuanced as far as what could help or what could hurt.
Possibly just paying them way down might be the best.
Yeah, paying them down to zero and keeping that payment history accurate and keeping that credit term or length of credit longer is gonna be what helps. Being patient is what's gonna help your credit score. Mortgages are gonna be a little different. Usually those are a 30-year term. So paying those off or are, I've never paid off a mortgage, so I wouldn't know. But I've had people who said that they paid off their mortgage and their credit score dropped. I've had people who've come and said they've paid off their mortgage. It took them 30 years, but they paid it off and their credit score actually dropped because they had.
You're not building that record of showing.
Well, because they had their longest. Your mortgage is going to be your longest line of credit, the longest credit history you have, and by paying that off and closing it, it's now not reporting to your credit report anymore. So it could hurt your credit.
Is now gone.
But hopefully by the time you pay off your mortgage, you don't even need a credit score anymore. Hopefully you're done with credit scores by then and you don't have to take out a mortgage.
Well, what if you're looking to buy more property, if you're looking to buy, say, a second home?
Yeah.
Because that's the reason I came here.
Yeah, no, that's a great point.
I'm hoping, I'm, in the next probably 2 to 3 years, my home will be paid for.
Mm-hmm.
And I'm looking to buy a second home, and that's what I was curious, that's one of the things, and I had thought
Yeah.
about before I came, and then I forgot, I'm glad she asked.
Yeah, no, that's a great point.
Once my home is paid for, now I don't have that credit history,
Mm-hmm.
and then I'm trying to get a line of credit for a second home.
No, that's a great point. Most likely, your mortgage loan officer is going to look at your credit, and they're going to see that you had a 30-year mortgage or a 15 or a 12, whatever it is. They're going to see that you had a mortgage, that you never had a late on that mortgage, even though it's closed. That is going to be more of an incentive for the bank to do a loan
Have equity.
because you have equity, you don't have a mortgage payment, so that's only increasing your income. You don't have any other debts, and you've shown the history of getting a mortgage and then paying it off. That to a bank is going to be stronger, even if your credit were to drop 20 points by paying that off. They're going to be able to look at that and say, well, even though it dropped, we have history showing that he's had a mortgage, he's paid it off, and he doesn't have that debt anymore, which means he has more income than he would have if he still had a mortgage. So that's going to be a plus big time for a bank to be able to do that. Yeah?
I just went onto your simulator and it reminded me that I have some student loans
Mhm.
that have been in pretty much abeyance because of the policies of Biden. And that's just about how we got me because of it.
Great. Student loans are reported differently to credit bureaus than like a credit card or an auto loan is. So there are different as far as rules and regulations as far as what types of loans affect your credit scores in different ways. So like medical bills, student loans, those things are going to either report or not report differently depending on the credit bureau. And it's so detailed and so nuanced as far as what falls into what category or what bureau reports it this way, whereas a different bureau would report it a different way. But yeah, student loans is one of those where it's a government loan, and so it's not a Zions Bank loan or a state bank loan. It's one that the government has secured, and so it's reported differently than if a financial institution was the one who lent it out. So
So that could suddenly, just because Trump's in and he's saying he has a different attitude about student loans, that could suddenly jump up and bite me, I think.
as far as like late payments, if there's any late payments or anything like that on it, you mean?
Well, I just haven't been having, it's been basically in forgiveness and
Mhm,
saying it's taking it away. It's still showing that I have it, because I haven't paid it off, but I also haven't come to payment.
Yeah. Yeah, because the payment's been in abeyance, you mean? Yeah. That is a great question. I don't know that I have the answer to that as far as how that could affect your credit score. Because I know there was a lot, especially when it was COVID, there was a lot with those types of loans being in abeyance and not having a payment due.
They put it in limbo till they determine whether or not they are.
They're going to collect on it or not,
And
yeah.
now, yes, with the changes,
Mm-hmm.
it's likely that it won't be forgiven, or they were trying to get it forgiven.
Yeah. So how that, but with it being a student loan, how that's going to affect your credit, I don't know. That's something that I think everybody's kind of in new territory with how that's going to be. So I can imagine it. Even though it might come out of abeyance, it negatively affecting your credit score would be would hurt a lot of people. So I don't know. I don't know how it's going to work out.
So as long as you pay it, I mean, right now it's just deferred, so there's no
Mm-hmm.
to do. So it's not gonna, the only thing that's gonna affect you is if they say, okay, payments are now due again and you don't pay it.
Right.
Oh, yeah, that's the problem when I don't have the funds anymore to do it.
So you need to kind of start planning,
Mhm.
if this does happen, what do I do? But, I mean, the key is, you live within your means, and you pay your bills. If you do that, you're gonna be 800 and higher score. You don't have to worry about all these little hiccups, but he's teaching you all the tricks to get to the 800.
Mm-hmm. being patient, making those payments on time, and just giving it enough time to really work. The last one I kind of wanted to go over, there's so many in here, so much you can kind of get lost in here, and it's very intuitive kind of system that we offer, is being able to set credit score goals. So you can come in here and set up your own credit score goal here and say, I want to get to a 640, or let's say I want to get up to a 740. That's the best, that's what's going to give me my best rate. And how long do you want to get to that? 12 months, 18 months, 24 months. And then what are you setting a goal for? Say I want to plan on making another big purchase, like a home that requires credit. You can come up here and set these credit score goals that will then track your progress over the next 18 or 24 months. And it will, as you're making payments on time, as you're staying below that credit utilization goal, it will then send you notifications saying, hey, your score's gone up 5 points, or your score's gone up 10 points. And it will kind of help you track that and help you reach those goals. It will also send you tips through your online banking or to your email as far as what you can do, what you can pay down that would help you reach those goals. And so it's just kind of a little simulator, a little credit score goals that you can set that will then help you track over that period of time where you're at and where you want to be. And with that, there is more. You've got these other tabs up here that will talk about different loan offers. If you were to transfer your credit card balances, this is how much you could save. I don't want to get too into that. It is something that's in there, but it's yes, you can structure your, if you have a higher interest rate, let's get you into a lower interest rate. And there are tools and things we can do that. But the biggest thing is let's get those payments made. Let's get those debts paid down to as low as we can. And then let's just give it time to build that history. And that's what's going to get your credit score up.